talk me around the tax benefits, because that's one of the key reasons why people do move into a self-managed super fund.
Yeah, a lot of tax benefits. One of the biggest things that people are concerned about is the federal budget changes. So no more negative gearing if you buy an investment property that's already established, not brand new. The capital gains tax discount is obviously being changed, and everyone's worried about, especially property investors buying in their own name or in a company or a trust, worried about paying a lot more capital gains tax in the future from 1 July 2027. So those changes actually don't impact self-managed super funds at this stage. So self-managed super funds still pay a maximum tax rate of 15%. If you've held a capital asset for more than a year, you're only paying capital gains tax of 10%. You can imagine for a lot of people paying top marginal rates of 47%, how attractive that 10% rate is. And then, once superannuation assets, once you retire, they're in pension phase, investment income, capital gains from that point on up to a cap are tax-free as well. So clients are looking at that and comparing it to the potential higher capital gains tax they're paying now and thinking, oh, wow, that's actually looking really attractive.
Yeah. So really, really strong tax benefits and a really good vehicle for it. I guess if we're kind of looking at the current position we're in now and people who are looking for a residential space, like we've just recently, as we're speaking, got an offer accepted for a client. And the thing is, I know we spoke about the reasons of why, but we didn't kind of touch on the balances, right? And a lot of people have a threshold in terms of where they feel a self-managed super fund should be set up to be sustainable. Now, the client that I'm working on, they've only got a balance about 250,000, but we've been able to secure a property for 735,000. And the rental on that is anywhere between $750 to $800 per week. So well above your 5% yield with a house that's probably just a bit over 7 years of age within 20 minutes of Perth. So when we're kind of looking at these scenarios and these situations, a lot of people do rule out the potential to step in a self-managed fund because they do feel their balances may not be quite there. If we're looking at from a resi, and obviously that's going to change, a balance of 250 still works. Similar enough, we did buy a commercial property for another client not too long ago, and that cost us 735,000. Now, the benefit with commercial, as you mentioned, was that the yields are stronger. That actually had a net yield of 7%. So
very attractive.
Very, very strong. Just because there's changes to the residential borrowing doesn't mean you close the door to the property market completely. It does have a shift of where do we go from here. Commercial is definitely a different avenue where there is a lot more risk involved, and it does require a bit of an appetite for it. So there's a lot more due diligence, there's a lot more research, and it's more heavily reliant on the actual tenancy, not just the actual property itself. Given that we are a couple of weeks away from the residential closure of borrowing, if someone is still considering setting up a self-managed super fund, what are the initial steps they need to take?
They need to talk to an advisor to see if it's right for them.
Yeah.
It's not right for everyone. The numbers need to stack up first. It costs money to set up. It is a bit more administration than your normal super fund, industry super fund. So you need to understand what your responsibilities are when you're trustee of your own SMSF. You also have the legal protections are slightly different as well from that sense, and you need to know what is it going to cost you, and then you need to have those projections ready to go, ready in your hand to say, okay, this is the setup cost, this is the annual cost. Is those either the growth or the yield on or the overall return on a specific opportunity going to make it worthwhile? But not only that, do the long-term tax benefits stack up as well when you compare that to maybe doing something in your own name? So those projections are key. Before you even consider setting up a self-managed super fund, and considering the costs and the responsibilities is key. So we can highlight all of that. We can advise on that. And it's really, really important that you do that, because you can end up losing a lot of money if you get this wrong.
Yeah. So what I'm gathering is that before you even think about setting up a self-managed fund, you need to have the right advice. You need to make sure it actually suits your situation and your circumstance. Yeah. And then you have to have a clear strategy in mind.
The biggest thing is the superannuation legislation that governs how an SMSF and what they need to do to remain compliant,
Yep.
that has to be strictly followed. Being non-compliant in your self-managed super fund is really high risk. You're putting yourself at risk of paying a lot of tax. So it's really, really important you have the right people looking after it, looking after you, so you know what you need to do that as well. But that's really where we step in, because our client base, a lot of them have self-managed super funds, but they rely on us to help them manage that for them as well. And so they have peace of mind knowing, I've got the right people in place to do all of that. They know what they're doing better than I do, and they're keeping me updated, and my SMSF is going to be compliant. And they're going to tell me exactly what I need to do, and especially what not to do. Actually, with SMSF. But where clients get a lot of value from that planning is actually looking at the specific opportunities. So where you say, this opportunity has a certain, expected growth rate, yield, and we can project that out and actually look at what do the outcomes look like in 10, 15 years. And again, do the numbers stack up, because that's the main thing. We shouldn't be, we should look at the strategy, but only act once we've got, the peace of mind. We're confident. We have that conviction that it's actually going to be worthwhile and actually add a lot of value.
Yeah. Fantastic. Sounds good. Awesome. Thank you so much, Aaron.
Thanks, Felix.